None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Wednesday morning, we talked about having the GDP come out, quite the revision. I'm going to bring Mitch in. We're going to be sticking to the schedule that we show you every time we come up now. It's important, I think, to give you guys some context so you know where to go in the show if there's just certain elements that you want to hear. So let's bring Mitchell in. Good morning, Mitch.
Good morning.
So, so 2.9% negative GDP. That's a lot of snow, right?
Yeah, that's it was a pretty rough winter, but man, I mean, I wonder at what point they're going to stop talking about the weather from this past winter.
Well, I don't remember it that way because I remember we didn't have a winter. I was in sandals all winter, and those of us on the West Coast weren't having the same kind of experience. Although they did have a fair amount of rain even up in Northern California last year, which they needed drastically. But anyway, once it started raining, it did rain. But yeah, 2.9 from what was it, -1 to 2.9. And what's going to be more interesting, because everybody's, obviously, market cares not at all, right?
Right.
It's like
market's up today. So.
Yeah, up 482. We're taking out almost half of the losses of yesterday. Not quite, getting close to it. It's inching up. We'll talk about some of the technicals here shortly on what I talked about in commentary and what appears to be going on at least midweek. This was my big party day I was hoping for, and not getting quite the party I was hoping for. I was thinking that there would be, if anything, the expectation was for a 1.8% decline in GDP, and I thought, well, maybe we'll only get a 1. They'll revise it back to what it was, and no chance. We ended up with a 2.9, but markets didn't care anyway. So, and yesterday was quite the joke, I thought. The whole really geopolitical risk, a bunch of crazy people running around in Iraq is going to affect the corporate profits in the United States somehow. Anyway, probably not it. What?
I think it's funny that yesterday the market took a nosedive because of news out of Iraq, and then today the market surges despite the actual economic news that comes out that's lower than expected, significantly so.
Yeah, and yesterday was better than expected.
Yeah.
And it started off yesterday. We managed to trade at the high end of the range at 1968 and went all the way through the bottom in the range. It was pretty narrow. I talked about the 3-day volatility had contracted to like 573. So it wasn't that big of order, but we did end up with about a 15, almost 16 point range on the S&P yesterday, which was certainly impressive compared to 5.73 for the previous 3-day on average. It's been pretty narrow. So there's not, I guess we had durables come out. They missed, right? We were supposed to be up 0.4 and it was -1. And there was consumers, what else came out? The consumer, it wasn't a sentiment. Anyway, I think that comes out on Friday. But anyway, bottom line is everything was kind of worse today than yesterday was better. And somehow Iraq played into yesterday. That was what the talking heads were telling you why the market was declining. The market wasn't declining for that purpose at all. I believe it was just declining because it was everybody's freaked out every time there's a new high and the market comes off the top. Everybody's like, oh, is that it? That's it, and they panic. And they've got one of these guys right here, Mr. Mouse, and they're clicking away, selling as fast as they can. And then they don't find out anything. And as I put it in the commentary last night, geopolitical risk equals opportunity, because this is a joke. I can even remember way back when they were tearing down the wall, and things were going crazy then, and the markets were declining. Oh, actually, it was the fall of Russia that was an interesting one. When all that stuff started to come apart, markets were down big, and I was on the floor of the Pacific Options Exchange. I walked up to the guy who was actually literally the largest trader on the floor and said, "What does this have to do with corporate profits in America?" And he kind of looks at me and goes, "I guess it doesn't," And we all started buying, and by the end of the day, of course, it was one of those typical days. You get that ugly day, and everybody realized it really didn't matter, and what was going on yesterday was more important than this event overnight that really wasn't going to affect anything here. And I think we're seeing that same thing. So let's go ahead and get started and walking through some of these charts and stuff here. I've got this is the 1 minute S&P futures. It's interesting. We're trading about 300 points off the highs right now. Not a lot going on. We're seeing kind of a consolidation, if you will, from the standpoint of what's going on with the markets. Not a lot going on. Some of my favorite charts, these cycles have been missing a little bit. It's been interesting how they've been misaligned the last couple of days. So there's definitely some kind of noise going on here. We're looking at the 5 minute futures here. And you can see we did have kind of this little cluster down here where when you're looking at intraday, trying to figure out, where is this thing going to go to, and from let's say from a hour-to-hour basis, or maybe every 2 or 3 hour cycles. We get 6 hours typically to work with here. But this little area right here where we see these spikes in. There's not many of them here. There was one up here toward the high, all the way in the far left-hand side of the screen, behind my shoulder there. But these are what their volume rate of changes. So it shows that there was an increase of volume, and this is something I talked about a lot. Most people think increase in volume means lower prices or follow through and downside. It means for me, and I've been watching this for a few years, like 34 of them. And it's never worked that way. There's occasion when there's high volume it continues, but for the most part they're climactic situations. Even here on a little 5 minute graph, it's that way. So but look at the hourly, and this is the 24-hour futures chart here. This cycle, you also see these similar cycles here, and that will show you exactly what how these cycles are running. It's about a 23-hour cycle, and like I said, they've been coming in lately. They've been, from a volume standpoint, you can see that these spikes are coming, but the cycle that was in place has been kind of misaligned a bit from where the actual. This was the last one that was pretty close to being on. All of these going across here have been kind of off cycle a little bit, but the small little volume spikes we're seeing are pretty good. This was around yesterday's high, this top spike here. You see the swing index, which is a VPM proprietary index that I built many years ago, matter of fact 1991. This indicator has shown a little extreme, which was the top of yesterday, and you can see the sharp decline that followed that, and now we've stabilized. We had a little spike around it. I guess the GDP this morning, they weren't sure what to do with it at first, so there was some volatility early on. Matter of fact, I want to look at the 5 minute graph and just see where that number came out over here. So you can see there was a little bit of a blip, and they thought, well, maybe this is bad, but then they quickly didn't care again, and the market rebounded right back into this range. Looking at going over to the the daily chart of the S&P cash, you can see a couple of things that happened. I thought it was interesting. I didn't really bring it up in commentary. I'm really hoping that a lot of folks that read commentary would also listen to this broadcast, because this first 15 minutes or so, the old podcasts that I used to do were about 8 or 9 minutes. So I'm trying to stick to this pattern of at least having this time focused in on what's going on in the S&P here. But we came down to the 21-day moving average. If you notice, I like to discuss. I'm going to get me out of the way here real quick, and just so you can see some of these indicator values that we're looking at. But the values of the PPMs looking at right now we're 0.5. In fact, yesterday, that was 0.0. It was exactly flat. So it's actually rising very slightly right now. The 21 is, we've got 1.127 and 0.09 on the 21 and 40 period moving averages here. So they're rising just slightly underneath there, which is enough to hold the market. If we go and look at what the values of the actual range was today relative to the moving averages, you'll see that the 1940.86 is the moving average. The low today was 47.49, so we didn't quite get to that. In fact, let me grab and blow that up just so we can see. It's so tight it's hard to see the range. So there's an indicator on here, which is the value indicator. The 3-day indicator I talk about is looking like it hit. The extreme is exactly 1940.17, which is downside projection for the day, happens to coincide with the 21 period moving average, which is 40.86. So those two numbers, that would be the extreme of the day. And in fact, in commentary last night, I talked about that even if the market did manage to go lower today, it would be the 1945.10 to 1942.50 be probably the most likely range. And then the extreme was 1940.20 for the day. So did not see the market going below there. That doesn't seem to be part of the scenario for today's action anyway. And so let's take a look at, as we always do, look at the weekly graph, see if what's changed there, which is virtually nothing, since all we're building right now is the bar from the standpoint of the range that we're seeing here is pretty much in where it's supposed to be. I'm going to grab my sheets from Monday, which give us the weekly range for the week, and my expectations were we'd see around 1978 on the upside. We got to 1968. Sounds like we're talking about history here, but 1970.45 was R1 on the weekly number. So we got there on the downside. S2 on the weekly was 1946.85. So we basically have come right down to, we've done R1 basically, R2 on the downside. So this may end up being the range for the week, and we may just plot along here quietly until the week closes out. Tomorrow we got jobless claims. Maybe there's something there, but there's really no news. It's really on to sentiment, and I guess if there's no news stories out of Iraq that somebody can grab onto and find a reason to sell, that will probably stay stable. I mentioned in commentary, just going back there, I'm going to go over to the hourly graph here real quick. And this is exactly the pattern that I was discussing in commentary here, so you know where I'm getting some of the context. When I'm talking about setting up a range, you're looking at pretty much the range of expectations here. This is the last 4 or 5 days is right here, this band here, and the market wants to just kind of chop in this range until it can go one way or the other. We'll find out which way. My guess is it's up yet because of the intermediate and some of the other values on the higher level charts. But this here right now is really, this is the most likely scenario, just going into this sideways range. It's not likely to make any drastic moves. And you can see the PPMs here are slightly negative, positive on the 40. So they're in this mode right here, where I'll circle this area here, like they were over here when you're making some sort of configuration here that sets up a bottom. We're doing the same thing over here with the current PPMs that I just drawn lines under. So you're just seeing this thing chop around. Lower the anxiety. It's not really, probably very little probability of the market going down very much. Like I said, the extreme would be 1940, and we're really in this trading range at the moment. I just don't see any real risk in the markets. Just to take a quick look, just to make the final review for the S&P 500, is looking at the monthly. Of course, nothing's changed there because we're building this monthly bar, although we are coming within the last 6 days of the end of the month, and this is going to put us into deciding what's going on from a momentum standpoint. We're 178, 147, and 105 ppm 1, 2, and 3. That's very robust. This thing is not going anywhere, and in fact, as I talked about several times before, the monthly trend is still expanding, which is pretty, I don't know what the right word is, phenomenal from the standpoint of from a trend follower viewpoint, and understand what's going on within this trend. It's not over, and how far, what can happen with this situation is we can hit finally a resistance point, or ultimately in hindsight what will be a top, and we'll see the market start to consolidate. But it's going to take several months of high-level consolidation to bleed off the upward momentum. It's sort of like the half pipe. If you take a half pipe and the ball rolls from one side to the other, each time it rolls it loses less and less till it settles in the bottom. Well, this thing has just been reset and it's bleeding off, but it's not going to bleed off much as long as each month we keep punching new highs out here. Since the low, which was the 17, let's see if I can pull this up here right, 1737 number that we made just a few months ago, we have seen consecutively higher closes, and there's this would be the fourth one. Typically, we'll at least get 5 to 8 months of that, so we could see, like I said, so much for the sell in May and go away. That's not going to work. Didn't work last year, not working this year. And the projections that we came out of the run and all the things we discussed on Monday is somewhere between a 14 to 17% gain from here. Interesting. I love some of the stories I happened to run across in CNBC last night of all the people that are becoming. They're talking about all these declines that are supposed to happen now, and I think these are the folks that want to get labeled as "we told you so" 2 weeks ago that there was a high coming, and they're making that guesstimate, hoping that they get it right, so they'll get some play and they'll bring them back on CNBC and say, "Oh, well, they called it," and all that kind of stuff. It's more about media hype than it is about being a good analyst, because a good analyst probably isn't calling it this way. I did say I have some friends from the bullish standpoint. Everything that I'm talking about here is based on statistical probability that we have seen occur, and I've seen and watched for actually the configuration that I'm looking at right now, and the indicators and things that developed have been in my life since 1984. So these are 30 years of experience that I've seen happen here, and the consistency that I've been able to call the market over the years is because of that understanding and being able to adhere to a set of rules that guides my analysis, as well as everything that goes on in VPM. So it's really important, and very few people have managed to master, have been able to master that. And I built this database with 18,400 symbols in it that all are being made the same analysis on, so I can bring some consistency from the database. And that's why we talk about the bullish percent, and the duration and some of the things we went through on Monday to make sure you understand that we're roughly 20% through the typical duration of this trade cycle that we re-entered. This, as I've talked about before, we have literally, this market has literally regenerated itself 3 times since '09. And it's happening again, even at these high levels. You see 3,600 new buys come in on Monday, and you think, well, maybe that's crazy. I'm just telling you that I looked at it, not 3,600 of them, but I looked at a lot of patterns that came out, and these things all seem to make sense. There are a lot of what I call level 3 buys. If you haven't seen that, go back and watch the video I did back in 2008, understanding the VPM modeling process. It's in our archives there in the VPM University. I believe it's in the very first set of videos. But what I'm talking about there is there's 3 different basic buy signals. There's one that happens down at the base, there's one that happens mid-level, and then there's one where it comes with this high-level breakout. And my favorite story around this, sorry to get down this trail. I'm so far down I can't get out of it now. But my favorite story was in 2000. We got a buy signal on AOL at 107. I can remember like it was yesterday. We had gotten out of it around 102. It broke out again, and it was 107. It was might have been even late '99 when that trade came out. And I remember one client, he goes, I can't buy this thing at 107. Well, it went from 107 to 500 off of that trade. They split it a couple times. They did all kinds of stuff. It was the .com boom that was on, and AOL was part of the players, even though it's probably the biggest dog ever in hindsight. They couldn't have made worse corporate decisions over the years after that. But at the time, there were a lot of trades. Colcom, we went from 30 to 800. There were crazy trades going on. And if you didn't adhere to the buy recommendations that were coming out and the criteria was going on, you just flat missed it. And we didn't miss it. And that particular portfolio that was in was, by the way, up 170% in 1999. So it was probably a late 99 buy. And when we rolled over in early 2000, we were selling all that stuff and taking profits and laughing all the way to the bank. I just wish I had the amount of customers we have now to really experience what that moment was like. But we're seeing another moment like this, and the reason why I bring this up is when you get into markets that just don't make sense. The .com rally did not make sense. Most of these companies weren't even making money. Okay, you just, you buy them because they're trending. If you're a trend follower, you follow the trend. The trend is clearly up, and that's why I spend all the time in these broadcasts to talk about this, because these are very significant. And let's face it, most of the customers walk in your office, whether they're business owners or individuals working, that's what they do. What we do is monitor these markets, and we're the scientists behind the scene trying to make sense of what's going on. And we need to have talking points, and it's really about trends and understanding trend and sentiment. Market sentiment is crazy bullish right now. You can ask Mark Halbert; he'll tell you what 66% of every analyst is bullish or whatever it is, and it's at some kind of weird peak. That's what it looks like when the market's going up. So volatility like we saw yesterday is what it looks like when the market's in this, because the markets are always responding to these constant, oh my gosh, this might be it moments. And so and the dynamics of how the markets move today are much different from the standpoint of looking at volatility, because of the access that everybody has. You got a digital access. There's no more 20 minutes to get an order in. It's 20 milliseconds. And so it's certainly much different. So anyway, I have babbled on about this enough probably, but I think it's interesting to have some perspective. These are the things that are coming to my mind as I'm looking at this, realizing that this is a special period in time from a stock market expansion time, whether it's being driven by the Fed or real corporate profits are just all the money that's been created and borrowed and who knows what. We've got a huge pool of money out there that is all chasing the same thing. We've got buyouts going on. I saw yesterday that the activity in M&A is the highest level it's been since '08. So we're coming back to pre-crisis levels, and there's just companies coming off, bringing stocks, buybacks. There's just the whole thing. I remember back in the 80s, and we did ultimately get the 87 high, but I was talking about this, I think Monday or sometime last week, is that we had this phenomena that in between 82 and 87, and 86 was probably the weirdest time because nothing made sense then either, but the market kept going up, and that's kind of what we're dealing with right now. And ultimately, this party will end, but it doesn't appear to be right now. Okay, I'm done. I'm sorry. I'm just going on and on here, but it's important, I guess, to me to have that perspective, at least so you folks understand if you're following our work and what the models are, what's driving this whole process. So, Mitch, you got to bail me out of this thing here. I'm going to bring you back on screen here and get me back down to earth here. I'm trying to find a screen where you exist with me.
I'm just a fly on the wall, huh?
Not even that. Yeah, let me get over here real quick and know. So yeah, we'll go to this other screen here. We'll go back to our New York Stock Exchange location. Anyway,
you had mentioned the rotation within the database, and we had mentioned before that we take a snapshot of the entire database on a weekly basis just to take essentially a survey of where all the portfolios are. And with this week, we're pegged at 84 and change % on the average portfolio. So obviously, depending on what you're invested in.
Do you have a high, low, or any of that stuff? Yeah, is that
not
high, low, standard deviation, all that fun stuff?
Not until I do a little bit more quality control.
I always catch him on this stuff. The average number. So, but what we're talking about here is average portfolio is about 84% invested. That's not 100. If it's index bound, then you're probably going to have just that. You're going to have 100% invested if you're doing an index strategy. If you're stock related, you're probably going to be 70 plus, 75 plus. Would be my guess.
Right.
We moved up to almost 70% of every stock in the system long. So typically, when you're looking at VPM portfolio, you're going to have like a I guess you're not going to be long all the stocks. I have seen periods when we've been long all the stocks in '08 when we were out of most of the stocks, if not completely out. But typically you're in that 65 to 70% range. And if you look at your trade profile on your portfolio, that's probably where you're at your upper end of percentage invested as well. So 70% of the stocks, if you have 24 stocks and you get 70% of them somewhere between 16 and 18 range, is going to put you 100% invested. So you're going to have those many stocks long, and depending on what type of rotation happened and rebalancing happened is going to determine a little more about how how your particular portfolio is positioned. If you've had rebalancing orders, then you're fully invested. If you haven't had rebalancing and you've just been buying some new purchases, then you're getting up probably to this 84 range. Anything else, Mitch? Are you playing with numbers, trying to come up with mine?
I'm doing some quick math.
That's okay. I
don't know if I'm going to get it quick enough.
No, that's okay. Hopefully you have a good list of stock of the day to go through. And go ahead.
I thought it'd be good, with all this conversation about what's going on in Iraq, and the ongoing conversation has been about, what's this going to do for the prices of oils. I thought it'd be good to highlight a few companies that are doing the shale oil domestically, so that way we could take a look and see, maybe there's some opportunity here and see some of the patterns on here. So this isn't necessarily a lot of stocks that advisors are currently using, but this might be an investment opportunity for the future. Right off the bat, let's do CLR.
All right, let me get a different screen. We're going to go just to the screen here.
And we're going to stick to the 1.2 weekly trade system on these, so I'll try to keep it easy on you.
All right, that'd be greatly appreciated. Okay, so yeah, we didn't really talk about our treasuries, but by the way, they're dropping again, down to 259. They're on the screen here. So much for higher yields and breaking out. Everything seems to have failed. You said 1.2. I'm going to go ahead and put that on there.
Yep.
Let's do 1.2, and yeah, it's just kind of interesting how the cash flows are going on here. I get so babbling on about the trends there that I think that these interest rates are going to be interesting. So give me that symbol again.
CLR.
CLR.
This is Continental Resources.
There we go. We're long this. Up 283 today. That's a nice move. Yeah, so once again, looking at this, the trend this is one of these things. I guess a continuing education of trend following and how things look here. Go ahead and come back on screen for you. I hate talking charts. Like to have some connection here with you folks. But yeah, so what's happening here is we've got PPM1 at 0.50 over here, PPM2 5.6 and 3.4. So the 21 period moving average is gaining somewhat on very narrowly, but gaining on the 10 period moving average, and that is typically what happens when we come into a consolidation range. So what's the plus on this, Mitch, as far as our current position? Well, I'm talking about this, but this trend is probably not ending, but it's certainly getting to the point where we're going to see a consolidation, so the market can make a decision whether it's going to go higher or not.
Currently up 11.5% on this.
Okay. Yeah, so not a lot there other than there's good solid trend. Anything over 0.25 is a bullish trend. We got that across the board, and all three of the moving averages and the PPMs are reflecting that trend mode. So even though, let's take a look and see what this value is. I'm going to see one value real quick here. So 152 is the 10 period moving average, 52.63. So basically, it's funny because I remember the day we used to always talk in eighths and sixteenths. So it would have been 152 and an 5/8. But it's yeah, we're into the digital world now, and the decimal pennies, trading by pennies anymore. So it's a much different world than I grew up in originally, I can tell you that. But and because of that old world, we had to convert digital into eighths all the times and decimals. So I actually know every decimal value from in 30 seconds. So and it's stuck in my head forever, I'm sure. Anyway, so the bottom line is that we're seeing some contraction here, but that's overall this trend is pretty good. Probably some consolidation. Let's take a real quick look. I'm going to look at this since we got in here. And by the way, that was the weekly. That was not the weekly graph I was looking at. So that's interesting. Let's take a look at it again here. 0.145, 0.168, still contracting. That was the daily charts we're looking at, and 0.13. So we're still getting. This is much different. I apologize for not paying attention. I was on a daily graph and not a weekly. But this trend is accelerating. Not only that, we have some Fibonacci's to take a look at here. So the Fibonacci objectives, VPM targets, are for 162 to 168. So that's going to be another close to 5-7% on the upside. So the daily's consolidating. So I apologize for that analysis. But the weekly graph has got some objectives, and we've seen this 146, 168, 114, PPM 1, 2, and 3, and that's just a very robust trend there. So, and this is another one of those one of those things. I got to point it out, I guess, since went got this far on this thing. This is another one of those where we bought it here, we made this trade, a positive trade, we got out, and then we bought it higher, and now we're making another 11%. So this little gap here is what we missed. Same thing again. We over here we looks like a flat trade here. This trend never got going. So the second and third trade worked pretty good. This thing is actually done pretty well at capturing whatever little bits are out there. I just drew some arrows on all the trades. So catching little bits, and when you're looking at a portfolio and you're doing a VPM portfolio dynamic, depending on when this is in and how it got there in the first place through a screen or whatever, you're gonna be putting those little bits in there. If you go and review and click on that bar on our dashboard that says trade impact, you can get an idea of what these little trades end up doing. They're cumulative profits that end up making your equity grow. It's funny how that works. Alrighty.
All right, next up on the list is HES. We're also long this position.
HES?
Yes, sir.
Okay. Similar pattern, 113, 122. The PPM2 suggests that 21 is gaining a bit on the 10 and 57, but all three in trend modes. We also have a Fibonacci objective here. Mitch, could you look at trade profile and see what we're expected to make on this trade?
Yeah, give me 1 second.
So looking at these Fibonacci's, 102 to 105 upside, we are 97. So not quite, another 5 to 7%, at least from a projective standpoint. And Mitch is going to tell us what the trade profile is suggesting that is the average trade that we make on this trade.
Yeah, the average gain on this is 20%.
Okay. So, and what are we up now?
We are up currently 13%.
Okay, so that's actually works right within the Fibonacci objectives. Is that about another 5 to 7? That's pretty typical what this particular trade does, and so everything's in line there. And this is a beauty, by the way, folks. This is the beauty of when you're in a trend like this. Everything works in a trend. You guys want to go build a trading model that works? Do it right now. It's going to work. The question is, will it work when the market rolls over, and how many markets environments has it seen? Everything works when the market goes up, I guess. But from a VPM standpoint, when you start looking at statistical mapping, that's why it's there, is to help build expectations, but also to have to be able to see how you're hitting those targets. And I can see quite a few good trend trades that came out of this particular model that are pretty good, actually. We're looking at right here, we're looking at this trade over here. It's got a line, TradeStation draws a line for the trades, the winners. And we got out and then got in and made a flat trade here, and then we're back in on this trade here. So this whole, I'm going to just draw a circle around this. This whole sequence here is part of that trend with corrective phases in between, and VPM is doing its best to capture that trend. When you see over here, draw another circle off to the left of that, you'll see there's in, out, in, out, in, out, and that is that's what it looks like when it's trying to maybe make a trend up, but it fails. Nothing was damaging there. These are small little trades. As I pointed out many times, ticket charges are not your enemy. The market is. All of this stuff, when you see these type of events, are very immaterial. I wish most of you guys weren't as emotional as you were over $7.95 or whatever.
That's right.
On a $250,000, $500,000 account. I guess it's really about your income if you're buying it. But the bottom line is, these aren't material. They are part of doing the cost of doing business, and each one of these trades could have worked but didn't. And so this is pretty typical when you start to look at a modeling process. You're looking at a dynamic environment, and individual stocks are way different than the indexes in the way they act. You got probably about 30% more trades in an individual stock than you will have on an index, just because of the more dynamic movement they have and the more corporate events. And in the big world of indexes, we've got, what we had today. We got GDP, we got 4 or 5 events that affect everything a little bit differently depending on market sentiment and how market participants are looking at the market. When you get into individual stocks, it's much more emotional because you've got love affairs going on that it's like when a stock misses, like catching your wife in a bar with another man. They just bail out, right? Everybody, oh no, how could this happen? And then you get all the emotion, and that's why you get the more volatility. Maybe a bad example, huh? Sorry.
Can't relate with you on that one.
Yeah, you never know. It'd be pretty devastating. But that's how stock traders act sometimes. Some of these events are so traumatic that you see these big 20 and 30% moves. It's just these monster disappointments. And I remember in 2001 when a lot of that stuff was happening, and they would miss. The expectations were like 3 cents a share in the company, or maybe 7 cents a share, and they'd miss, and they'd come up with 6, and it would just crush the stock for 30% on a penny miss. I'm like, why would you? What's that about? It's just that any disappointment in that kind of market environment, that sentiment would have this overreaction to what's going on. So maybe that was the second wife. Every time she went out, he would panic. He would have an emotional explosion, but nothing happened anyway. I'm sorry. That's a really bad analogy. I need to get off this. Interesting day today. But let's go on to the next stock then.
All right, next stock is HK, Helcon Resources.
And still 1-2, right?
Yes, sir.
Okay.
We're long all of these, and they're also on 1.2 on all of these, coincidentally.
All right. How'd you find these?
I was just doing some research, trying to find something that, as far as a story to be found when it comes to domestic oil. And so obviously up here in the Twin Cities, with North Dakota just to our west, I thought I'd focus on shale today over in the Bakken oil reserves.
All right. Yeah, I guess that's the big deal anymore, right? That's what's going on. It's the energy boom. We're the Saudi Arabia of North America.
Yeah, that's what they say. I mean, there's tremendous opportunity over there, and if you could tolerate the winters up here, and we'll see if we keep having them quite like they are. But I mean, it's amazing just to hear the stories out of the Dakotas as far as the oil coming out of there and the wealth that's getting created as a result of mining for the soil or drilling for the soil.
Yeah, and it's just that's what all this unemployment people. I saw an interesting article one day that said, want a job? Move.
Yeah.
And people get stuck in areas for whatever reason. I don't know. I'm part gypsy. I've lived in about 5 different areas of this country and enjoyed every place I've been. I've been in Northern California, grew up in Chicago, found out 28 years that 60 below zero is really bad for you. You can die. So I left there, went to California, and then went to Arizona and Texas, and then back here actually had a little stint in Australia. But, it just, life's about choices, so.
Yeah, it's one of those things. I grew up in Flint, Michigan. Unemployment currently is right around 16% unemployment. The reason why I didn't stay there is because there was greater opportunities elsewhere, but I still like the Midwest, despite the winters that we get.
Yeah, you're a sick man. There's something wrong with you. Anyway, yeah, we'll get off the weather thing. So let's move on to the next deal here.
So with this stock, you see it's been pretty volatile. If I were to include something like this in my portfolio, is there any concerns I should have when I see this type of volatility like we've seen in prior years? And that sort of goes to the other question, when you're looking for participation in a commodity, actually selecting the producers as opposed to the commodity itself. What are your thoughts around that?
I don't know. I wouldn't have, I don't know how to, I'm not a fundamental analyst to the point of looking at an industry and going, which is better. I don't know. We'll call Jim Kramer on that one.
Okay.
But from a technical viewpoint, this type of volatility to me is magic, because if you look at what's happening from I guess just from the volatility standpoint, if you look at the big decline that you see in the screen over on the left-hand side, just happened to be 2008. So right here we got out of this trade when it broke down. We got in, we broke even roughly. Could look at it and see exactly what we did. Stayed out, and then had the creepy crawler, had a positive trade, a flat trade. Looks like flat, maybe a little loss, and then finally in 2011 got the big trade to the upside, and here, and now we got flat, and then good. So if you look at the trade log in this stock, if you just happen to like this stock, then you're going to be able to, I guess, leave it in your portfolio. It did good, but there were times over the years where it was what I call pie filler. So you're not really getting a lot of activity, or on a trade impact chart, you're not getting much impact in some areas. But when it does impact it, it's good. I mean, I've seen static portfolios, and as I guess process warriors. We talked a little bit about this. Probably can talk a lot more about more static, slower moving from changing constituents and those things. There's a couple ways to look at screening and updating. Then typically what we do is talk to you about, updating on a quarterly basis and rotating stocks and rotating all that stuff. The outliers. There's other ways to look at it. I've seen static portfolios do quite well over the years. So what's our next stock?
Next stock is KOG, Kodiak Oil.
1-2 as well. These
Yep.
are all 1-2s. Okay.
These are all 1-2s.
Okay. Alrighty. So looking at this again, trend's not quite as robust, and in fact, this may be a consolidation phase that we're having right here. This chart is likely to be. You can see the PPM2 is up 127, while the PPM1 is only up 0.18, and in fact, momentum has been declining recently on this particular stock on a short-term basis. So what's most likely going to happen is it's going to consolidate there. Mitch, while I'm talking, if you could look up and see what our expected returns are in this stock. It looks like there's a couple good trades, but it looks like it's not a big the expectation, it doesn't look like. My guess is probably 12-14%. We'll see.
Yeah, just pulling it up right now. The last stock we had, we were currently up 65% in that stock, which is pretty nice.
Yeah, that is. Yeah, that's that was Hess, or what was it? HK. Yeah.
This stock currently up 6% on it, and we're expecting. Bear with me 1 second.
Trade profile button.
Yeah, average win on this is 116%, so we're a ways away from that.
Wow. Okay, that's surprising. That must have been one giant trade early on.
Yeah, that's what I'm looking at right now.
That's one of the things we talked about on Process Warriors the other day, is you gotta look at it. I believe in Portfolio Expert, don't we give a ER based on the range on the chart, or did we not do that? I can't remember.
No,
That's
we
still
don't
the
do that.
same. Yeah. Now, one of the things that'd be nice to know is what the ER is for the last 3 years or 5 years, because it's a lot different than that, I guarantee you.
Yeah, and this is one of those cases where it went from a penny stock, where we had a couple really nice trades on it. Back in 2005, made 292% on it. 2010 made 489% on it.
Yeah.
As it went from 40 cents to $2.30 when we got out of it. So.
Gotcha.
Yeah, so those are great examples of it wrecking the average on it. But this has really had a lot of solid returns on it. 5%, 292, 11, 5, at 49, 55, 45, 22, and now we're currently up 6% in it, which that doesn't sound as exotic or robust as the others, but we'll see where this goes.
Yeah. Okay.
Next up on the list I have is OAS, Oasis Petroleum.
I am attempting to do something real quick, folks. Just bear with me 1 second.
Just pulling it up in the 2.0 system as well. I'm bouncing around between both 2.0 and Portfolio Expert as well as my cheat sheet here.
Yeah, I didn't have a screen set up that both Mitch and I could be on the same screen, so we have that now. So now I'm right in the way of this chart. Oasis has not been around a real long time, fairly new. But it's interesting, I guess, on the previous stock, with the ranges going from a penny stock to reality, I guess some of those things actually work.
Yeah.
They're not all pump and dump trades. There's actually real companies that start off and evolve out of that environment. They're not all Googles that start off with a multi-billion-dollar valuation, or Facebooks that have no income or very little income that can come out at 100 billion or whatever the number was. The perception of what's real is actually not real.
Yeah, completely off topic, but I remember seeing an article, a survey done recently about Facebook, more about social media and advertising. And it was some ridiculous number, like over 60% of survey participants stated that advertising had no effect on them whatsoever, and another 30% on top of that said it had very little effect. So I wonder what that's going to do to these social media companies when they actually start realizing that all the efforts, all the marketing dollars that they go into it, at best they're a nuisance, at worst they're completely ignored.
Yeah.
And I don't know. It'll be interesting, when you have 90% of survey respondents saying it does nothing for them. That's a lot of money thrown.
Yeah, I skip them whenever I'm around.
Yeah.
So I think most do. So this Oasis trend now, 107, 112, 138, very robust trend. There is a minor configuration here that we can look at, and that is the Fibonacci objectives here, 56 to 57. So not quite, another 8-9% on the upside.
Which lines up pretty good, because right now we're long 10% on it, and average gains on this are 26%. So
okay, yeah. So, and yeah. So it'd be nice to know what's the standard dev on that. Should give it to you right there.
Yeah, standard deviation on this is 60% in this
Wow.
case.
So yeah, so the returns are all over the place. Once again, I'm sure some early trades, like when Oasis came out, big trades in the early stages. And one of the things that you want, there's nothing wrong with having the big trades. It is going to skew ER ratio. I know that's for another show, talking about process warriors, but ER ratios can be skewed by a couple of these early trades. Like a good example, probably in the was it the HK that went from penny to reality?
Yeah.
Yeah. So stocks like that's going to have a monster ER ratio, which after it's stabilized and become a real company, that's not the actual way it works. But would be nice for us to come up with a way to at least give a more maybe a 5-year, have windows like you do on returns to look at ERs as well.
Yeah, I do have a few tools internally that do that, but
yeah.
we haven't had a chance yet to bring that out. To,
yeah, and there's 18,400 of them. You have to maybe pick some stocks to be able to do that on. So that might be a little much. Next.
Last one on my list is WLL.
Okay. What is this? Whiting Petroleum. All 1-2s again. So,
Yep.
yeah. I mean, I guess in looking at the first thing I see, I love this because this is a classic. Let me bring up the whiteboard because this is what you want to see just on what's on the screen. This is a great stock. What's the ER on this one?
ER ratio on this is 337.
Yeah. Look at it. I'm just going to point out this elongated trend from here to here. There were two trades, and we made this trade here in this segment. We paid more. Doggone it. I'm sorry. Yes, we paid up when the trend evolved, and there was very little adverse excursion on this trade once it started. In fact, I think am I in the way? No, I'm okay. And then we got out here, and then another good trade out. Then we did buy lower, but we didn't make money by buying lower. We ended up going flat. Another good trade here, and then we got out. The market could have kept going down. It didn't. It stabilized, and then a new trend established itself and went from there. And what's our expectations on the upside here?
Expectations on this one are 52%. I'm currently up 5%.
Yeah.
A lot of that has to do with the fact that we had in 2008, 2010, a gain of 97% and now 142% off those trades. So
right. Yeah. So that's good.
Nice trades to be made.
But that's these trades I was pointing out, I guess, huh?
Yep.
Look, this is a recovery 09 trades. So between 09 and 11, there are two really good trades on this stock. And listen, it comes down to doing individual stocks. It's stock selection and stock selection.
Yep.
And you want to find things that have volatility like this that will actually trend. The concept we've seen advisors come up with, we want to get things that don't have a lot of volatility and have dividends. No, that's not for VPM. That's for I don't know what it's for. I always say amateurs buy dividends, but there's good stuff when there are times when that makes sense to own. I know a lot of the MLPs and got a lot of play in that, just for lots of you trying to get some yield in your portfolio. And there's two ways to make yield. You can get paid for interest, or you can make capital gains. So they all end up working out the same. It doesn't matter how you get the money. And if you can get long-term capital gains, they're usually better off than interest gains anyway. So, I've always been make money in the market and not try to get paid while I'm waiting, I guess, that's the view of that world, but not one that I live in. It's certainly, that's an opinion. Anyway, so this current trend is, once again, 56,140. So we've seen almost every one of these charts. We're seeing the PPM2 indicating that the 21 is gaining on the 10, which suggests a consolidation range of some sort. Does not suggest the end of the trend at the moment. Usually they'll consolidate, and then there'll be another leg up if the continuation is going on. And who knows, if nothing else happens out of the Iraqi situation, maybe it bumps crude oil up a little bit more. We spent all this time. What do we got left here? About a minute and a half, so probably not enough time to do that. Let's go and go back to the chart here, and let's just take a quick look at the how the market's been trading since we're there. It's been paint drying. We're still at 441. We were pushing closer to 5 points. We backed off a little bit off the highs, but we're pretty stable. I usually like to give a view of what to expect to the end of the day, and it looks to me stable markets probably have seen the range for the day. Let's go to the cash markets very quickly here, and just to see what that is. Let me get to a daily graph. Actually, we'll go 60-minute. So we're looking at high 56.76, low 57. We got about a 9, almost a 10-point range. So we're probably have seen the best or the worst of whatever's going to happen today. I expect a consolidation. Higher close today, I talked about this in commentary, negates yesterday's outside reversal, which tells you trading range at least for the next 3 to 5 days. I'll certainly be updating that. And then we'll look forward to seeing you on Market Thunder on Friday morning for a recap of the week and a summary of what's happened. And tomorrow on Process Warriors. Miss, you remember what we're doing on Process Warriors?
Portfolio expert.
Oh, that's right. Yeah. So, so we're going to be doing Portfolio Expert and some of the things that we have to offer there from different things from VPM 2.0. Anyway, folks, we appreciate your time again. We thank you for watching, and being customers and all that good stuff. And we really appreciate everything. Thanks a lot. We'll talk to you tomorrow.